Breaking news, shares of Tesla rebounding this morning after wiping out over $150 billion on Thursday. You can see pre-market here, shares up over 4%. We have some conflicting reports on whether or not President Trump and Tesla CEO Elon Musk are expected to speak today off the back of this public feud playing out on social media, leading to that huge fall off in the Tesla share price. If we can take a look at Tesla over the past couple of days here, you can see those huge declines, and obviously the majority of those declines coming yesterday as that feud played out on social media. If we look at a longer dated chart, though, you can see the huge run up that we saw in Tesla stock, especially after the November election. You saw the stock hitting upwards of 44% to its all-time high, and then declining over 40% from that prior all-time high off the back of some slew of issues for the company, including slowing sales, but then also Elon Musk's closeness to the White House, which was originally the catalyst to move it to the upside, now being one of the things that is weighing on investor sentiment. We're going to continue to cover what happens with Tesla throughout the trading day.
All right, Maddie, we are just moments away from the May payrolls print. Let's set the scene here. The expectations as we're waiting for the number to cross in just under a minute here. The non-farm payrolls are anticipated to come in at 126,000 for the month of May here. We're also going to be looking across the unemployment rate, measuring up against this 4.2% expectation. And then additionally, one of the labor force participation rates expectations there, 62.6%. And then average hourly earnings, another area that we're going to be watching month over month, 0.3%, year over year, 3.7%. You're taking a look at futures here coming into the print here, and we are seeing gains right now across the board, about 0.4% for all of the U.S. major averages right now, Maddie.
Yep, and we are just seconds away from the jobs data crossing the wire here. We have a little bit of a beat. The number coming in at 139,000. That is above the survey estimate, which was 126,000 added jobs over the course of the month. Change in private payrolls, also a bit of a beat, coming in at 140,000. The estimate being 120,000. Taking a look at unemployment rate, coming in bang in line with estimates at 4.2%. That is also identical to the prior reading, which was at 4.2%. The labor force participation rate, just a tick below the survey estimate of 62.6%. That came in at 62.4%. Broadly looking like a good set of numbers across the board here. You also had average hourly earnings rising a tick. It came in up 0.4% month over month. The estimate was 0.3% of gains when it came to those average hourly earnings month over month. You also had a beat on average hourly earnings year over year, coming in at 3.9%, the estimate of 3.7%. And then lastly, we like to look at the average weekly hours for employees. That is a gauge of how confident companies are. Maybe they're pulling back. That also came bang in line with the survey estimate. We are also getting in some revisions here. One thing that's interesting is there was a downward revision for the prior payrolls print that came in at 177,000. That was revised down to 147,000. And it's interesting to see really across the board here. It does look like on a headline basis, a pretty strong report in the stock market cheering as a result.
Yeah, and actually multiple revisions down here, both for March and April. March was revised down by 65,000 from 185,000 to 120,000. So that combined with the April downward revision, you've actually got March and April combined 95,000 jobs lower than previously reported here. So that's why it's important to track the revisions. Also important to track some of the sectors here as well. The employment here, it continued to trend up in healthcare, leisure and hospitality, social assistance as well. That leisure and hospitality sector, one of the through lines that we could have drawn from the ADP private payrolls prints, that was really the by and large gainer there. And then the federal government here, that continued to lose jobs. May come as no surprise given some of the accelerated cuts that we had heard and continued to monitor in previous prints as well here. And so we're going to dive deeper into that in a hot moment. Joining us now to break down the jobs report, we've got Greg Dacco, who is the EY Chief Economist, and Brish Khurana, who is the Wellington Management Fixed Income Portfolio Manager. Great to have both of you here in studio with us on a summer Friday, no less, but a lot of fireworks here out of the gate this morning. Downward revisions, plus you got the prints that largely came in just a slight hair higher than expectations on the headline print. Unemployment rate essentially in line with expectations. Greg, what's your read in here?
Well, I think we're seeing a softening in the labor market. I think that's undeniable, but it's not a retrenchment in the labor market, and that's what was feared. It's still likely something that may happen over the coming months because we are seeing business leaders, business managers being very cautious about the outlook and noticing that this increase in cost pressures from the tariffs will require some form of reaction, whether it's raising selling prices across the board, managing inventory, or unfortunately having to reduce headcount to reduce labor costs. There will be some further cuts down the road. I think we have to focus also on the fact that there were some significant downward revisions. That puts the labor market on a lower trajectory when it comes to job growth. And even though the unemployment rate did not rise, we saw a pullback in labor force participation. That tells me that labor supply is under pressure from induced immigration. That's going to be another factor that we have to pay close attention to.
So it sounds like you'd characterize this report as not bad, but you wouldn't call it good.
It's a moderate report, moderate to modest, if we were to use the Fed's beige book terminology. I don't think it changes how the Fed is going to perceive the outlook when it comes to the robustness of the labor market.
So then, Bridge, bringing you into the conversation, rate cut expectations falling below 50 basis points already in the bond market right now. What do you think about rate cut expectations after this print?
I mean, I think the bond market, it's usually doesn't get it right, but I think it got it right in this case. The market's still pricing in about 2 cuts by the end of the year. I think where I would probably disagree a little bit is that I think those are going to be much more backloaded. And I think after the ADP print a few days ago, I was getting questions, could June be live again if we do get a very low print? And I think at this point, this number is good enough that it takes away June. I think the Fed is going to want to see more data. Have we seen the progress on the inflation side over the last few months has been quite good. Does that continue for the next month? Maybe July is possible, but I think with this, the labor market is not cracking yet, even though it's decelerating. And I think you need to see an unemployment rate really above 4.5% before the Fed starts engaging more with the labor part of their mandate compared to the inflation part of their mandate.
With these revisions that we'd seen downward, to the extent that the Fed is looking at that data and really monitoring where their trend is starting to set in, because I think we're seeing markets actually move higher on the anticipation that that trend is starting to really be elucidated because of those downward revisions, plus the anticipation of if we were to see more cuts coming, that's going to impact the consumer psyche far more, especially as we read through prints like the Conference Board's Consumer Confidence Index, where they know that based on whatever they see in the opportunity for employment, that's very much going to be the signal for spending as well.
Yeah, I agree. I think if you look at private payroll growth, it's about 1% right now. And we've constantly seen these downward revisions for the last year or so. I haven't seen a lot of upward revisions in the last year. And actually the Fed does adjust for it. They say, usually it's been, stats have been overemphasizing it. But I think over time, we'd expect private payroll growth to come in at around 50 basis points in increase a year, which is close to around 60,000 jobs, which will get the unemployment rate higher. Once again, though, I do think that's going to be more backloaded. And I think a lot of the cuts that we're seeing out of the government, whether or not it's from DOGE or state and local funding, a lot of those budgets are set around now and start to impact job gains in the latter half of the year. And so I do think that is why you'll start to see more weakness probably in the latter part of the year.
Well, Musk just left. Are the government cuts done?
No, I think they won't be done in terms of what we're going to see in the data. We're seeing a slow trickling of job cuts. But if you look at the job cuts announcements, they surged in the month of March, and we have yet to see that filter through into the data. Instead, what we're seeing is a trickling of these job cuts. And I would point to job cuts as being a good forward-looking signal as to how the payrolls are going to evolve in the coming months. One thing that I've been quite concerned about is what we're seeing on the retail front. If you look at retail employment, the number of job cuts announced through the month of May are up about 274% relative to last year, so almost fourfold relative to last year. That portends to a slowdown in retail sector employment. And in fact, in this report, we did see a blemish in the fact that retail employment fell. The other segment where we're seeing some cuts is on the goods side. Manufacturing, construction, seeing weakness in terms of payrolls. That is directly reflective of the impact of tariffs that is gradually filtering through. And the third blemish that I saw in this report is temporary employment. We also saw a decline in temporary employment. That's generally not a good sign in terms of forward-looking indicator because businesses are getting rid of their temporary employees employees first before they get rid of more permanent employees.
And to your point also, one, the president doesn't want to see a decrease in manufacturing jobs at the moment, but also leisure and hospitality should be in a really hot season right now, so it makes sense to see those categories leading. Greg, because we don't have the full impact, the full net effect yet of those tariff policies, how much worse could this data potentially be, or is this type of sort of mixed jobs report going to be the new normal?
I'll give you a stat that I find fascinating. If you look at customs duties that have been collected by the US as of the month of May, we had an effective tariff rate of 6.7%. The average tariff rate right now is 14%. In the month of April, it was 25%. What that tells me is that the tariffs are starting to bite, but they're nowhere near their full effect in terms of their consequences for inflation and for economic activity. That means that we're still going to see more of an impact over the coming months. And because the data tend to lag a little bit, we're going to have to wait until the summer, to your point, Bridge, about seeing this data really reflecting the full extent of the tariffs. That won't occur until the month of July, August, September. And that's where you're going to see a more pronounced slowdown in economic activity. And beware of one thing in terms of the GDP growth data. We're going to see a wild swing in imports to the downside, which is going to support a GDP print in the second quarter that's likely to be in the 3% or potentially higher vicinity, which will give false signals to everyone.
That's a great point, Greg.
Bridge, where in the fixed income duration landscape do you feel confident right now?
Yeah, I mean, we're one of the contrarian investors who actually think that there is some value in longer term bonds. I think I understand the reasons budget deficits are continuing at a very drastic levels for the foreseeable future. But I think what people forget about long duration bonds is that you can move a little part of your portfolio to get interest rate sensitivity into it. And, that hasn't mattered because there has been this positive correlation between stocks and bonds where, when bonds go down, stocks go down and vice versa. And, I think that correlation could be changing if you have lower growth and you have lower inflation, which, I do think we are starting to see signs of that. And so I think that negative correlation could reestablish itself. That being said, as I said, I'm very wary of the fiscal situation. So we feel more comfortable, almost somewhat hiding out in inflation protected securities at the back end of the curve, and also going globally, focusing on countries like Australia, New Zealand, Norway, countries where, Norway has a $2 trillion sovereign wealth fund. They don't need to issue any debt, and yet yields are very similar to the US. And so kind of having more of a global orientation, you would avoid a lot of that fiscal noise that we have in the US right now.
Thank you both so much. Really appreciate it. Greg and Bridge, thank you so much for joining us. Let's send it over to our own Jared Blickery for a look at the movers on the back of the May payrolls report.
Thank you, Maddie. We are seeing a little bit of a risk-on movement here, and I'll show you what's going on in the stock futures. This is our map of the world. And keep in mind that most of these markets that we're going to show here were already up. And this is the Russell 2000 futures. You can see since midnight just treading water, and then we spiked higher here. Just a caveat, too, that a lot of times in the early morning after a payrolls report, we do get a reversal and sometimes a resumption of the trend. Suffice to say that we got to wait until the close at 4 p.m. today to get the most accurate picture. So that was the Russell. This is the Dow, up about 1/3 to 1/2 of what the Russell is. Still seeing a little bit of a pop there. And let's check out the S&P 500 as well, up about 0.8%. And let's take a look at the 5-day. So we are in positive territory for the 5-day, as we have been for the most part since about Tuesday. But the leader this week has really been the NASDAQ. It's just up a little bit more, 1%. And we saw that spike yesterday. We saw a little bit of a breakout. I'm going to show you the year-to-date chart, where you can see we're just edging higher ever so slowly, ever so closer to these record highs that we had way back in February. So we're getting there, but just very small steps. Volatility has been contracting, which is another risk-on sign here. But here's what's happening in the bond market. These are 2-year U.S. Treasury note futures. So these move opposite yields. We're seeing them head down on the report, which means yields are going up. And that is, we saw yields come down yesterday, so we'll have to see where things land, especially when we track the open today. But here's the 10-year. That's also down. We saw a big reduction in the 10-year and the 30-year yesterday. And then gold, a little bit of a sell-off here on the news. So gold has been very strong, still very close to its record highs, just above $3,500 per ounce. And let's check out silver as well, because that has really stolen the show this week. This is a 5-day look, up almost 5 5% there. And if we put a year to date, we can see it has just broken to the highs. You have to go all the way back to about 2011 to find a higher price in silver futures. Anyway, they're not doing that much this morning. And I'm going to also take a look at Bitcoin. Bitcoin has sometimes led the risk markets on and off, but we're seeing almost no reaction right here. So just call that a no reaction in Bitcoin and in crypto. Here's the sector action. So consumer discretionary is up 1.38%. Guess what? That's a Tesla story. We'll take a look at that in a minute. Not rebounding off of the news this morning, but interesting nevertheless. Then we also have tech. That's up about 89 basis points. By the way, the background color there is what happened yesterday. So you can see most of these sectors, except for that green one, communication services, they were all down yesterday. And today, almost all of them are up, with the exception of real estate. So consumer discretionary, tech, financials, industrials, all of those are leading this morning. And as promised, let's get a look at the NASDAQ 100, where I'll leave off here. We can see the mega caps largely in the green. Broadcom, which just has been hitting record highs over the last few days, that is down this morning. But let's check out Tesla, which was down 14% yesterday, but is up another 4.63% today. Here's a year to date, still in negative territory and a little bit worse off than a couple days ago. So Tesla down 30%. We're going to be tracking the saga between Elon Musk and Donald Trump all day, I'm sure. And for the most part, we're looking at this risk on action after the payrolls report. But keep in mind, a lot of times after the open, we do get some kind of a reversal. On that, I'll send it back to you, Maddie.
Jared, thanks so much as always. Coming up, we're going to have more on the May payrolls report and a look at what sectors gained and lost the most jobs. That's next on Yahoo Finance to Ground.
The May jobs report showing 139,000 jobs added, with unemployment holding steady at 4.2%. Our very own Alexandra Canal joining us now for a deeper dive into some of the numbers. Hey, Alex.
Hi, Brad. Yes, well, I want to start with government jobs, particularly federal employment. All eyes are on those layoffs from the Department of Government Efficiency, otherwise known as DOGE. And for the month of May, we did see federal employment continue to decline, down 22,000. Since January, that sector of jobs down by 59,000. Again, as a reminder, employees who are on paid leave or they're receiving ongoing severance, they are counted as employed in this establishment survey. So possibly we are going to see more pain to come over the coming months and into the fall. And that's something that economists have been saying to us. And also economists have been telling us that federal spending cuts might have spillover effects into other sectors of the economy, such as state and local government, employment, and education, along with healthcare. But so far, we are not seeing that materialize. And I want to talk about healthcare because added 62,000 jobs in May, higher than the average monthly gain that we've seen over the past year. The bulk of those gains concentrated in hospitals, leisure, and hospitality, also a standout here. Significant move to the upside, 48,000 jobs added, more than double its average monthly gain. This was largely in food services and drinking places. And with the summer season fast approaching, it's not totally a surprise that we saw that upward trend there. But I am curious if we see a consumer that potentially pulls back on their discretionary spend, maybe they don't go out, dine out as often, how that potentially could trickle through into the employment situation there. But so far, not seeing that just yet. And then finally, I do want to end on manufacturing. Pretty much little change there. We saw a decline of 8,000 jobs. That was a bit more significant than what we saw in April, when employment in manufacturing declined by 1,000. Tariffs are something that could significantly weigh on the manufacturing sector, and we could see that in upcoming reports. And we know that June report, it's going to be coming at a time when potentially we could see the Trump tax bill be signed into Congress. We could also potentially have those reciprocal tariffs in play. So a lot to come in the months ahead. But so far, this report showing that we have a pretty stable labor market right now.
Yeah, and certainly seeing that playing out in the market action, hitting session highs ahead of the market open. Allie, thank you so much. Great overview. Futures rising on the back of that May jobs report. The U.S. adding more jobs than expected at 139,000. Unemployment holding steady at 4.2%. Joining us now, Marianne Bartel, Sanctuary Wealth's Chief Investment Strategist. Marianne, it's great to have you on this morning. Talk to me about the degree of positive reaction that we're seeing from investors this morning, given the fact that the 2-month revision had a decline of 95,000 jobs. What's driving the optimism?
I think because you still have a good labor market. The unemployment rate is at 4%. When I was in college, the natural unemployment rate was 6%. So I would even argue that not only do you have full employment, but you're probably even past that. And when we look at, real income per capita, that's growing very strongly. So when you have a strong labor market, a consumer that's making money, and we did see wages tick up a bit, that would generally leads to stronger corporate profits leads to a positive equity market. And I think that's why we're seeing the equity market rally in here.
And so, as we're continuing to watch what the read-through is in the equity markets evaluation of a myriad of different things, whether that be coming from 1600 Pennsylvania Avenue or whether it be coming from anticipation of what the Fed will do off of prints like this jobs report, where do you think that weighting is continuing to be? And at what point will there be a pivot?
I don't think we know when that pivot's going to come. I mean, obviously, I've said tariffs are, a temporary interruption. If we didn't have tariffs, the markets would already be at record all-time highs. So I think we have to get through the noise of this. We have to get through the big, beautiful bill. And at least the way the market is trading, it's suggesting that we're not going to have a major deviation or a major negative. We've had breadth at record all-time highs. We have volume at all-time highs, which is very unusual because normally the markets hit the highs first, and then your breadth and volume hit record all-time highs. So I'm fairly confident that the market is looking past all of this. They see it as a net positive. And what we've been telling our clients is that we're expecting new highs this summer. In fact, ironically, the market, meaning the S&P 500, is trading very similar to 2018. We could get some chop in here as we're up near the highs. The June months can be a little choppy, but we're looking for new highs this summer. And if we follow 2018, that means new highs hit in August.
Explain to me, Marianne, what exactly is going to drive us there? Of course, historically, we've been seeing that it's those big tech names, but what specifically is going to be the catalyst to drive further gains in those stocks?
So our outlook has been, and it's not unlike other things that you've heard before, artificial intelligence is a game changer. But it's not just artificial intelligence. You also have robotics. You have virtual reality. You have Web3, the crypto space. These are massive technological advancements that we've never even seen in our lifetime, all happening at the same time. And most, not all, of the technology is hubbed here in the United States. So if you want to invest in these markets, particularly if you want to even go into the private markets, if you want to go into the VC, venture capital markets, you have to come here. So I understand that money may be moving overseas, but I think in time, you're going to see some of that money come back as these company stocks continue to actually lead the market. This is still led by tech, and I call tech related because some of these related stocks are in other industry groups like communication services with Google and Meta. These are the leaders of the market. And we believe we're in a secular bull market. And as long as these leaders are intact, your secular bull market is intact. So I'm still very bullish tech and tech related. I really don't see a lot in the value space, but I do like the financials. If I was looking at the value space, I would look within the financials.
2018, it was Fang or Fang Man or wherever we were at in that point. It could have been, well, it wasn't quite Batman at that point. But now it's all things generative AI in the Mag 7. And so as we kind of draw parallels between 2018 and now and where there are similarities and who is kind of giving the biggest thrust point for the market right now, they're all signaling something similar, which is deal scrutiny that they're hearing from some of their largest clients. How is that one of the headwinds that they will need to move through that the rest of the markets as well, if they are to ride on the coattails, that the other 493 will have to be making sure that they're navigating?
Well, again, it comes down to earnings. When you really dissect the market and you look at where the earnings are coming from, it's definitely not small cap. There's still a large percentage there that are not reporting any earnings. And when we look at where the strength of earnings are coming from, they're coming from tech and tech-related companies. So when we really analyze earnings, they're scarce. We don't have an abundance of earnings in the market. And, the history books show when you have a scarcity of earnings, growth outperforms, and growth is tech and tech related. So although you're going to have headwinds, the market will remain focused on earnings and will buy those companies that are producing the earnings. And right now, that's still tech related.
Marianne Bartels, thanks so much for taking the time here ahead of the opening bell, as we're just about 30 plus minutes out from the opening cross. Thank you.
Thank you.
That does it for our jobs report special. A quick check-in on markets across asset classes. First, let's take a look at the U.S. major averages. Fractional gains as of right now. The Dow up 0.7%, about the same for the S&P 500 and the Nasdaq, 0.8%. We'll give that credit. And then additionally, taking a look at bonds here. Here's the move for the 5, the 10, and the 30-year yields. We are higher across the board here. And then additionally, let's check in on currency. The dollar, the greenback. We're seeing a rise there of about 0.4%. We've got much more on the jobs coverage ahead after the break. Stay tuned.